A sweeping set of banking regulations just took effect on March 1st. And here's what has me deeply concerned about this. For millions of Americans, these coordinated changes could affect how quickly you can access your money, whether your transactions get flagged without warning, and how much documentation you suddenly need just to use your own account. Most people aren't going to hear about this until something actually goes wrong, until they're trying to deposit a check that gets held for days, or attempting to send money that gets blocked for reasons nobody can explain. But you're learning about it right now, which gives you the chance to prepare and protect your money before these tighter systems catch you off guard. Before we continue, if you want to stay updated on banking changes that could directly impact your money, hit subscribe and turn on notifications. We break down financial news like this regularly, the kind that actually affects your accounts and your daily life. All right, let's get into it. March 1st, 2026 wasn't just another day in banking. It was the day multiple federal agencies simultaneously tightened the entire financial system. The Financial Crimes Enforcement Network updated real estate reporting. The FDIC changed digital disclosure requirements. The Consumer Financial Protection Bureau modified lending regulations. The National Credit Union Administration extended rate caps. And perhaps most significantly, NACHA, the organization that governs the ACH network, implemented enhanced fraud monitoring that affects every electronic payment in America. All of these changes went live within the same 30-day window. That's not coincidence. That's systematic recalibration. And if you think this doesn't affect you because you're not doing anything wrong, that's exactly why you need to pay attention. Let me tell you about a man named Marcus. He's 67 years old, retired from teaching, and has been banking with the same institution for 23 years. 3 weeks ago, Marcus sold his old truck for $7,000 cash, completely legal transaction. He went to his bank to deposit that money. The teller processed it and told him the funds would be available in 7 to 10 business days, pending a compliance review. Marcus asked what that meant. The teller couldn't provide specifics. 10 days went by. Marcus still couldn't access his money. When he finally reached customer service, they told him his account had been flagged under enhanced monitoring protocols. They needed documentation proving where the cash came from, a bill of sale for the truck, copies of his ID, and written explanations of his banking activity. During that waiting period, his mortgage payment bounced. His utilities autopay failed. He ended up with over $300 in late fees. I'll come back to Marcus's situation shortly, because what eventually happened shows exactly why everyone needs to understand these regulatory changes. Here's why all of this is happening. Over the past several years, federal regulators have faced mounting pressure to crack down on financial crimes. Money laundering, fraud schemes, businesses hiding ownership. These are legitimate problems. So regulators responded by making the rules much stricter. The issue is that when you tighten verification and expand automated monitoring, you dramatically increase false positives. Legitimate transactions get incorrectly flagged. Regular people get swept into compliance reviews that freeze their money for weeks. And here's what really concerns advocates. Once your account gets flagged, even if you're completely innocent, that flag becomes part of your banking history. Multiple flags can result in your account being classified as high risk. And once that label gets attached, banks can close your account, refuse new ones, or report you to databases that other institutions check. Getting cleared can take months or years. Let me break down the 6 key changes that rolled out on March 1st. The first change involves the ACH fraud monitoring shift that took effect March 20th. NACHA requires enhanced risk-based fraud monitoring. Translation: banks must turn up the sensitivity of their automated fraud detection systems significantly. More pattern tracking, more anomaly detection, more algorithmic scrutiny. And here's the part nobody explains properly. These systems freeze first and ask questions later. Not because you're guilty, but because the algorithm detected a deviation. If you normally spend $100 per transaction and suddenly spend $900, flagged immediately. If you normally receive 2 deposits a month and suddenly get 5, flagged for review. If you move money faster than your historical pattern, flagged pending verification. Type declined in the comments if your debit card has ever been randomly rejected, even though you had money in your account. Under these new rules, it's going to happen to significantly more people. The second change involves broader capital and supervision adjustments across financial institutions. March 2026 brought heavier regulatory scrutiny on how banks manage fraud mitigation, liquidity stress, and compliance reporting. When regulators increase supervision, banks reduce risk tolerance. When risk tolerance drops, monitoring gets stricter, account reviews happen faster, false positives increase. This is systematic. When pressure flows downward, it lands on you. The third change hits anyone in real estate. Effective March 1st, the Financial Crimes Enforcement Network implemented the Residential Real Estate Reporting Rule. If you buy property through LLCs, trusts, or entity structures, there's now dramatically expanded reporting visibility. The goal is anti-money laundering. The effect is more transparency, more documentation, more scrutiny on beneficial ownership. If you're in real estate investing using entities, your compliance burden just increased measurably. The fourth change affects FDIC digital disclosures. Banks must now clearly disclose FDIC insurance status across all digital platforms. Why? Because fintech confusion exploded. Apps look like banks. Consumers didn't know what was insured. This change is positive for clarity, but it's another indicator of tighter oversight. The fifth change involves PACE financing. The Consumer Financial Protection Bureau updated truth in lending exemptions around these loans. PACE loans for clean energy improvements now require expanded disclosures, more consumer protections, more federal involvement. Again, more oversight and compliance. The sixth change affects credit unions. The National Credit Union Administration extended the federal credit union loan interest rate cap at 18% through September 10, 2027. It was set to expire March 10th and drop to 15%. Now, payday alternative loans remain capped at 28%. Regulators said if they drop this to 15%, some higher-risk borrowers would lose access to credit entirely. This move preserves lending access, but keeps rates high. Now zoom out. What do all these changes have in common? More visibility, more monitoring, more documentation, more compliance, more automation. March 2026 wasn't random. It was a coordinated tightening cycle. And when systems tighten, the margin for unusual behavior shrinks. If your financial behavior is clean, organized, and predictable, you'll feel minimal friction. But if it's variable, high volume, or business-like in personal accounts, you'll definitely feel more friction. Let's talk about who this affects most. If you run side hustles through personal accounts, receive frequent Zelle payments, deposit inconsistent amounts, invest in real estate through entities, borrow from credit unions, or move money internationally, your compliance burden increased, not dramatically, but measurable. Automation is now front and center in banking risk management. And automation doesn't care about your explanation. It cares about deviation. Now, let's talk about exactly what you should do to protect yourself. 7 specific action steps. Step 1. Separate business and personal banking immediately if you haven't already. Mixing them is one of the fastest ways to trigger flags. Step 2. Keep detailed documentation for every large or unusual deposit. If you sell a car, keep the bill of sale. If a family member sends money, keep a record. When your bank questions a deposit, having documentation ready resolves it in hours instead of weeks. Step 3. Pre-notify your bank before large or unusual transfers. A simple call saying you're about to deposit $8,000 from selling your truck can prevent days of frozen funds. Step 4. If you own business entities, make certain your beneficial ownership filings are accurate and up to date. If paperwork doesn't match reality, expect delays. Step 5. Turn on real-time transaction alerts for every account. Know immediately if something unexpected happens. Step 6. If borrowing from credit unions, compare rates carefully under the 18% cap. Understand what you're agreeing to. Step 7. Avoid unnecessary cash deposits when possible. Cash triggers more scrutiny than electronic transfers. These 7 steps won't guarantee you'll never experience a flag, but they'll substantially reduce your risk and speed up resolution if problems occur. This isn't panic content. This is awareness content. The financial system didn't collapse on March 1st. It recalibrated. When recalibration happens, people who understand the new direction move smoothly. People who assume everything works the same way get blindsided by frozen accounts. March 2026, tighten the screws. Slightly, strategically, systematically. If you stay organized and proactive, you'll be fine. But if you operate on autopilot, assuming nothing will happen because you're not doing anything wrong, automated systems will surprise you. Now, let me finish Marcus's story. After 10 days of back and forth, providing documentation and waiting for compliance review, his account finally got unfrozen. But during those 10 days, his mortgage bounced, his utilities failed. He accumulated over $300 in late fees. And the stress of being locked out of his own money took a serious toll. The bank eventually cleared everything and acknowledged the deposit was legitimate, but never refunded his late fees. But let me tell you about Marcus's neighbor, James, who runs a similar financial life. When James heard about these new rules, he didn't wait. He called his bank proactively, confirmed his information was current, asked what documentation they might need. A few weeks later, James sold his motorcycle for $5,000. Before depositing the cash, he called the bank, told them it was coming, explained where it came from. When James made that deposit, nothing happened. No flag, no hold, no freeze. The money was available the next day. James spent 20 minutes preparing. Marcus spent 10 days locked out and lost hundreds of dollars. Same regulatory environment, completely different outcomes. The only difference was preparation. The main point is straightforward but critical. These coordinated regulatory changes are real. They took effect March 1st. They're affecting how banks monitor your accounts right now. This isn't about creating fear. It's about making sure you have accurate information about what changed. Update your contact information today. Log into your online banking and verify your address, phone, and email are current. Banks send critical notices through these channels. If they're using outdated information, you won't receive warnings until your account is already restricted. Keep digital and physical copies of your ID, proof of address, and anything that explains your income sources. Be ready for extra questions about anything unusual. Turn on those transaction alerts and watch out for scanners exploiting confusion around these changes. Let me be clear about what your bank will never do. They'll never call and ask for your full account number, PIN, password, or social security number. They already have that. They'll never threaten to close your account immediately unless you act within minutes. They'll never ask you to transfer money to a safe account. That's always a scam. And they'll never text or email links demanding you click through and enter personal details. If you receive communication like this, hang up or delete it. Then contact your bank using the number on your card or their official website. Now, let's say your account still gets flagged. What then? First, stay calm. Ask clear questions. What triggered this flag? What documentation do you need? How long will this take? Write everything down. Second, Provide whatever they're requesting as fast as possible. Third, if normal customer service isn't helping, de-escalate. Ask for a supervisor. Request direct contact with compliance. File a formal complaint if necessary. You can also contact the Consumer Financial Protection Bureau. Fourth, if you're locked out and need money for genuine emergencies, tell them explicitly. Many banks have procedures for releasing partial funds during reviews. Hit subscribe if this is helping you understand what changed and how to protect yourself. Type "aware" in the comments if you're moving smarter now. I understand some people feel these changes represent government overreach. That frustration is valid. But here's reality. Financial crimes exist. Regulators are under pressure to address them. Banks have to follow federal rules, whether they agree or not. Getting angry at your local branch won't change regulations from Washington. Focus on what you control, being prepared and understanding how the system works. Remember the difference between Marcus and James. Same transaction, opposite outcomes. Marcus lost 10 days and hundreds of dollars. James spent 20 minutes preparing and had zero problems. The system treats prepared people differently, even when both are innocent. The main message is straightforward. These regulatory changes are real. They happened March 1st. They're affecting accounts right now. Update your contact information today. Separate business and personal banking. Keep documentation. Pre-notify banks before large transactions. Turn on alerts. Compare rates carefully. Avoid unnecessary cash. These steps minimize your risk and speed up resolution if problems occur. Getting flagged doesn't mean you did anything wrong. It just means you need to be ready to demonstrate your transactions are legitimate. If this helped you understand what's happening, make sure you're subscribed so you don't miss future updates. Leave a comment if you've experienced account issues recently. Have you gotten verification requests? Had deposits held? Your experiences help guide what we cover next. If this information was useful, share it with your friends and family. Anyone with a bank account should know about these changes. It's about understanding how the system operates now, so you can protect yourself. Thanks for watching.